Hello. In this video, we'll be going over capitalized costs for intangible assets, including goodwill. We've seen this slide before about the different categories for long-term assets that help produce revenue. And they are the property, plant, and equipment, typically called PP&E, and natural resources. These two categories are covered each in individual videos. In this video, we'll be talking about intangible assets, such as patents, copyrights, trademarks, franchises, and goodwill. So let's talk about intangible assets and some of the issues that go along with them. What are intangible assets? Well, we've talked about property, plant, and equipment, which are considered to be tangible assets. These are physical assets that you can touch. You can touch a table, you can touch equipment. Intangible assets lack physical substance. You cannot touch them, but they are still an asset that provide future benefits and therefore are capitalized on the balance sheet. Typically, they represent exclusive rights to provide goods and services. And we'll go through some of those examples in later slides, which is why I'm not going to go through it right now. When you have an exclusive right to provide goods or services, you could either purchase it from another entity, such as a patent, a copyright, or a trademark, or you can develop them internally, such as when you develop a new product and then it's patented. Think of Pfizer, when they developed the COVID-19 vaccine, they had it patented. That means that they have the exclusive right to produce that asset for a certain number of years. It would be 20 years for a patent. After you capitalize an intangible asset, which, if you recall, to capitalize an asset means that you're going to record it on the balance sheet. In this situation, they are going to be long-term because intangible assets are long-term assets. Once you capitalize an intangible asset, if that asset has a finite useful life, means a specific number of years or months or periods that are finite, it will end at some point. Then we will amortize them, which will become covered in a different video. If an intangible asset has an indefinite useful life, which means it could be an asset forever, and typically this is considered to be goodwill, then you do not amortize them because there is no life to amortize them over. So what's the cost of the purchased intangible? Remember, the cost is going to be the amount that is capitalized on the balance sheet. What's the purchase price if it's purchased? Plus all other costs necessary to get the asset ready for use. There could be all sort of legal fees, titles, things of that nature that need to be incurred in order to be able to use that asset. And then just this last bullet point right here is internally development cost. Internal development, meaning when we incur cost to internally develop an asset, those items are typically expensed on the income statement in the period that they're incurred. And that's usually because there's uncertainty, right? There's uncertainty as to whether there will be future benefit from that development. Internal development cost means the company's researching, think of research and development, they're looking into seeing if something is viable, if an asset is viable, if they can use it in the future. And the outcome may be, maybe an asset might be created, or maybe an item might be created that can be patented, or it could be scrapped because they can see that it's not going to work. So internal development costs are expensed because there's uncertainty as to whether there is future benefit from those costs. Here are some of the more common intangible assets, and I will go through some of them. So a patent is an exclusive right to manufacture a product or use a process. I briefly mentioned about Pfizer developing the COVID-19 vaccine. Think of like Apple has patented its facial recognition system, like their Face ID technology. Apple has filed a patent for that. And if that patent is granted, because there's a U.S. Patent and Trademark Office, right, there's a whole application for the patents. If it's granted, then a company can amortize the cost of that patent over 20 years. And so what is that cost? It includes the purchase price if it was purchased, legal fees, filing fees, but it does not include, not including any internal research and development. Again, because there is such uncertainty in whether those costs would end up producing future benefit. The next intangible we'll be talking about are copyrights. And copyrights protect the original creative works of films, music, and books, right? Their exclusive right protect those published works. An example is Disney owns a copyright to the script, the animation, and soundtrack of a movie, let's call it Frozen, and which prevents other companies, organizations from reproducing or distributing anything related to Frozen. Another example is the Harry Potter series, like J.K. Rowling has the copyright for the books and anything published in any sort of adaptation and merchandise related to Harry Potter. Once again, you have to apply for a copyright. Once it is granted by the U.S. Copyright Office, the life of that copyright is considered to be equal to the life of the creator plus 70 years. Those costs, again, are the purchase price, legal fees, and filing fees, but do not include any sort of internal or research and development costs. So let's talk about trademarks. Trademarks give a company or organization a right to display a word, a slogan, a symbol, or anything that distinctly identifies a company, product, or service. So think of Nike's swoosh logo is their symbol or their slogan, right? And that's a Nike trademark. They own the rights to display that swoosh. That looks like a check mark, but you know, I'm trying to make a swoosh. And you register that with the U.S. Patent and Trademark Office, and that can be, the cost of that can be amortized over 10 years. Again, the cost of the purchase price, legal fees, filing fees, does not include any sort of internal R&D. And then lastly, just based on this slide, there's franchises. And those are exclusive rights by a franchisor to the franchisee to use the franchisor's trademark. So the easiest way to think of that is the McDonald's franchises. McDonald's Corporation issues McDonald's stores as franchises. So the franchisee pays McDonald's Corporation for the right to use the McDonald's brand, their system, their products. So for most McDonald's that you go into, they are most likely a franchise. So an individual or maybe a small LLC owns that McDonald's and they pay a franchise fee to McDonald's Corp, the corporation, and they might also pay some royalties or whatnot to McDonald's Corporation in order for the right to operate as a McDonald's. Those costs that the franchisee pays to the franchisor are what is the intangible asset that we are talking about. And the franchisor grants the franchisee the right to use their name or product for a specific period of time. So if someone who owns a McDonald's or is franchising a McDonald's has an agreement with McDonald's Corporation that they can operate that McDonald's for 20 years, then those franchise fees are capitalized and then amortized over 20 years. But it can vary depending on the agreement between the franchisor and franchisee. So what costs are actually capitalized It's the initial payment, so plus the periodic payments over the life of the franchise agreement and any legal costs. So if I want to open up a McDonald's, I would have to pay some sort of initial payment to McDonald Corporation. Let's call it $1 million, plus either whether it's monthly, quarterly, or annual payments over the life of the franchise agreement. I would also have to pay that as well. All those costs are considered to be franchise costs, and they are capitalized as an intangible asset. Goodwill is another type of intangible asset, and goodwill represents the value, it's the value of a company as a whole, like you take a whole company, over and above its identifiable tangible and intangible assets. So when you look at, let's just say, Apple, right? Apple, if you look at all of its on its balance sheets, identifiable tangible and intangible assets, and you add those all up, the value of Apple is much larger than those assets on their balance sheet. And that goodwill is developed, right, because of whether the company produces a product that becomes really well known, it has a good reputation. You can have really goodwill because you train your employees and your management team is fantastic. You can have goodwill also based on your business location. And goodwill cannot be separated from an actual company, right? When you say, what's the goodwill of Apple Corporation or Apple Inc., you can't separate it from a company. So it's only possible to identify goodwill when an entire company is purchased. So, and then the amount of the goodwill when a company acquires another company, right, and the part of that acquisition cost will be allocated to goodwill. The way that is calculated is you look at the fair value of the consideration given in exchange for the company. So think of this as the selling price minus the fair value of all the identifiable net assets acquired. So notice this is fair value, not the book value. So not the book value. It's the fair value of the identifiable net assets. So net assets is going to be your assets minus your liability. That equals your net assets. So you're going to look at your fair value of all the assets of the company you acquired minus the fair value of the liabilities, which it's usually recorded at fair value. And whatever that total is, you pay more than that amount, and the difference between the selling price and this net asset amount, the fair value of the net asset, is considered to be goodwill. Let's take an example. The Knight Corporation acquired all of the outstanding common stock of the Ryder Corporation in exchange for $180 million cash. That is our selling price. So, right, Knight Corporation acquired Ryder Corporation for $180 million. Knight assumed all of Ryder's liabilities, which have a fair value of $120 million at the date of acquisition, and the fair values of all identifiable assets of Ryder are as follows. So Ryder had $50 million of receivables, $70 million of inventory, property, plant, and equipment of $90 million, and patents of $40 million. So I want to point out that those assets are the fair value. So in this example, the property, plant, and equipment was a fair value of $90 million. And that might be the fair value in the date of acquisitions. When the company acquired the property, plant, and equipment, it might have cost them $200 million, and now they could have depreciated, let's just say $50 million, right? So on their books, it's $150 million, but their fair value is far less. Or it could be flipped. You can have inventory that costs you very little money, but since you've purchased that inventory, the demand for it has gone up, which drives the selling price of that inventory up, which determines your fair value. So again, it's not just what's on your books, it's the fair value. So how do we calculate the goodwill? Again, goodwill can only be generated when a corporation is acquired as a whole by another entity. So the fair value is going to be the selling price, which in this case was the $180 million, or fair value of consideration given, less the fair value of identifying net assets. So we're going to take our fair value of the identifiable assets acquired, which is going to be the 50 million plus 70 plus 90 plus 40. That gives us $250 million. But then we also assumed their liabilities of $120 million. So we got $250 million worth of assets, but we owe $120 million. So net, the net assets that we acquired is $130 million. So we take the 180 minus 130, and our goodwill that we would capitalize on our balance sheet is $50 million. How do we record that? Well, you're going to record, now we've acquired it. Our cash price is 180 million, so we're going to credit cash for 180, and then we're going to debit each of the assets that we acquired through this sale. So receivables, inventory, PP&E, and patents at their fair value. You can see the amounts listed here. We also assume their liabilities, so we have so now it's our liability. Right now, it's Knight Corporation's liability to that they are obligated to pay. So we have a credit of 120, and then the difference between them is going to be the $50 million, and it's an asset, so we're going to debit that asset, and it's going to be part of our intangible asset. Here we have just a couple of slides summarizing the intangible assets, describing the naming the asset, describing what it is, and the typical cost that we use to capitalize, and also making sure that we know that the internal research and development costs are not capitalized. There's a separate video all about research and development, or R&D costs. So if you want to just take a picture or refer to these slides, feel free. I think they're really useful because it's a lot of information to grasp for each one of these items.